Welcome to the third episode of our webcast series on the forthcoming IFRS Accounting Standard subsidiaries without public accountability disclosures. And in this webcast, we will be discussing the potential effects of the new standard on the preparers of financial statements with Michael Stewart. Michael is a senior expert of financial reporting at Huawei, and he has worked with the project team developing the standard throughout the project's life. And thank you for coming here and being with us today. And perhaps you could start with talking a little bit about Huawei and what interests you in this project.
Sure, thank you. Well, Huawei is a large international technology company headquartered in China, but with operations in more than 150 countries around the world. We specialize in telecoms and known for our telecoms work, both in terms of the networks, the telecom networks, and also handsets. But we also are operating in digital power, so green energy technology, cloud computing, and also automotive, where we provide operating systems for use in electric vehicles. We operate, as I say, in 150 countries around the world, and typically we have at least one subsidiary in each of those countries. Depends on the nature of the operations within those countries, but a lot of those are sort of distribution and service type companies. Now, each of those subsidiaries gets consolidated into our IFRS financial statements, and that's managed by, we have 5 shared service companies around the world, 5 shared service centres, and they take care of a lot of the preparation of the subsidiary financial statements in these various countries. Those subsidiaries also prepare separate financial statements according to local laws and regulations. Sometimes those will be IFRS. Some countries allow that. Others may do a local GAAP that's based very closely on IFRS, what I like to call sort of local IFRS, if you like. And then others have to do local GAAP, which might be quite different from IFRS. And the users of those subsidiary financial statements are typically the local tax authority and local customers and maybe local suppliers as well, when they're doing their due diligence on doing business with us. Myself, in terms of what's interesting to me about the project, I work in accounting policy for Huawei, and so I'm often providing support to our local shared service centres as they prepare the subsidiary financial statements. And so provide them advice on complying with IFRS. And so whenever this project was first adopted by the IASB as being a project on its agenda, then I was very interested because I could see how it could be applicable for us. And so I've been following very closely the development from the very beginning there through sort of the development of the exposure draft and analysing that and the proposals, etc. And even back in 2021, I think it was, I took part in a panel discussion at the IFRS Foundation conference, which I think was just before the exposure draft was published even. And just, so following its development there, and so very interested to see what this new final standard is going to provide for us.
Oh, thank you for that points. And the ISB's aim in developing the new standard was responding to feedback from the preparers that some challenges arise in preparing financial statements of subsidiaries because when the parent prepares consolidated financial statements in IFRS accounting standards and the subsidiary applies a different accounting standards, for example, IFRS for SMEs accounting standard or local GAAP. And can you explain these challenges for your company?
Sure. So as I mentioned, our subsidiaries all have to do or all do IFRS reporting for group consolidation purposes. So that they're already doing that for group. They also have to prepare in accordance with local requirements. Where those requirements are not IFRS, such as when it's a local gap that's different from IFRS, then that does mean them having to keep two sets of books effectively. And so that adds complexity, it adds cost, and obviously an important part of what my colleagues do in the shared service centres is tracking those differences between local reporting and group IFRS reporting. And you mentioned the IFRS for SMEs. So obviously that is its own standalone set of reporting, a self-contained standard, and it has some measurement differences from regular full IFRS. And so that would be, similar to the local gap reporting in that a second set of books having to be kept. So whenever our subsidiaries have the option to use IFRS for local subsidiary reporting, then we tend to choose that because it means that it's just the one set of numbers that we're having to deal with for both group reporting and local reporting. And that's even if that means more onerous local disclosures, because it means doing full IFRS disclosures, which might seem excessive potentially, given the nature of the operations. I mentioned near the beginning that some of these subsidiaries are sort of distribution companies or service companies. So some of them may be relatively straightforward in terms of the nature of their business, but we would typically choose to use IFRS where that's available, because the extra work on the disclosures is worth it for more straightforward keeping of one set of books. So that for us is a real attraction. And in fact, there's a small number of jurisdictions around the world which provide or allow that sort of reduced disclosure, a bit like the new IFRS standard, the UK FRS 101 being an example of that. So as I say, when we saw this being added to the board's agenda, we were very pleased to follow the progress of the development of this new standard.
Michael, do you think the forthcoming standard will achieve this aim, helping to resolve the burden and complexity that would arise from maintaining the two set of books?
I think from what I've seen from the exposure draft, yes, I think it will. Adopting any new standard, in the first year, there's always additional work and effort required in sort of reviewing the requirements, checking them, working out what needs to be done to comply with them, setting up new processes and procedures and controls as well associated with that. But, I can see a number of savings that we would hope to achieve from this on an ongoing basis. So first of all, there's, when I looked at the ED, I was thinking, well, look, there's a shorter list of disclosure requirements here that I need to work through to work out which ones apply to our subsidiaries. So the fact that it's a shorter list compared with the full IFRS standards and all of the pages of disclosure requirements that there are in there, even just reviewing those, I think will save time and effort. And then, of course, because these disclosures are more tailored towards the needs of a privately owned company, then I think there's the potential for reduced disclosures in those standards, in those statements, in any case. So reduced time and costs involved in preparing the information that does need to be given. And then both of those factors, I think, can lead to audit savings as well. So first of all, the auditors themselves don't need to go through the pages of disclosure requirements that are in the full IFRS standards. There's just this set of disclosure requirements from the new IFRS. So there's less for them to be checking about what might be applicable for our subsidiaries when they're doing their audit. And also when looking at these, because as I say, these seem to me to be more tailored towards the needs of users of privately owned subsidiary, that therefore the whole audit process, I'm hoping, will be shorter as well from the disclosure point of view. So that should, I'm hoping, lead to reduced time and therefore reduced costs as well from an audit perspective. So I think there's a double benefit potentially for us here. Now, obviously, the extent to which there are these sort of savings does depend on the extent to which the board in the final standard has, reduced disclosures compared with full IFRS. And I do get that obviously the IASB needs to weigh the needs of the typical users of these sorts of financial statements with the preparation of disclosures that need to be given. So it will come down to partly that, and also the complexity of the business. So, a fairly straightforward company will probably need to give fewer disclosures, but a more complex one will obviously need to give more. But that's natural and reflective of the nature of the company, and I think that's appropriate. The one area where I was, in following the project that I was hoping the board would change compared with the exposure draft was the scope. So the scope being that it has to be a subsidiary, whereas I was thinking, well, certainly from a conceptual point of view, why not have the same scope as the SME standard, which of course is where the board started from in preparing the exposure draft. And, why does the entity have to be a subsidiary? If it's privately owned, then why not qualify for these reduced disclosures, which is of course the alternative view that Françoise Flores published in the exposure draft. And but following the development of the project, I've followed the arguments that the board made, and I can understand those. And at the end of the day, I'd rather this standard than no reduced disclosure standards. So, I'm still happy with what the board is proposing.
Thank you. And you mentioned the costs, and the IASB thinks that transitions cost will vary depending on where a subsidiary is transitioning from. For example, from IFRS Accounting Standard or a local GAAP, sometimes we call it as a starting point. And do you agree with this? And what are your views on these transition costs?
So I guess one real practical issue is that it can only be used where it's permitted to be used. So first of all, in terms of being simply or a straightforward IFRS standard part of IFRS, that's fine for those subsidiaries of ours that use IFRS. So, but it also depends on the local jurisdiction. If they've got an endorsement or adoption regime, actually adopting this new IFRS standard into the suite of IFRS standards that's available for our use. So that's a key element as well. Where there is local IFRS, what I call local IFRS, so a local GAAP that's very close to IFRS, again, will they adopt this new standard, incorporate it into their local GAAP? That's going to be important. Now, both of those situations, it does depend on the local standard setter, regulator, depending on how it's set up in that country, actually adopting this new standard. And I certainly hope that, everyone involved in, the standard setting community and the audit profession, preparers will work to support the local standard setter or local regulator to do whatever work they need to satisfy themselves that it can be used locally. That's certainly my wish to see that happen. And when I was sort of thinking about this and thinking about it in the context of Huawei included, is there are some jurisdictions obviously where it's not IFRS or even local IFRS, it is local GAAP different from IFRS. And I do wonder whether the issuance of this new standard might encourage some jurisdictions that don't yet allow IFRS to be used for subsidiary accounting to perhaps permit that, because I wonder whether it might just help tilt the balance in terms of the cost benefit assessment in favour of allowing private subsidiaries to to use IFRS and the standard playing a part of that. So that would be my hope for this.
Thank you so much, Michael. I think your contribution is very valuable for us and for the purpose of this webcast. And this brings us to the end of the webcast. And thank you for listening us today.